We warned you this would happen. We told you that when the banks began to lose control of the silver price, they would not simply stand aside and let the market do what markets are supposed to do. We told you that when the short sellers were pushed to the brink of extinction, the system itself would step in to save them. And we told you that if they couldn't win the game, they would change the rules of the game. Today, Tuesday, January 13th, 2026, they changed the rules. While most people were watching silver attempt to break above $86 an ounce, something far more important was happening behind the scenes. The Chicago Mercantile Exchange, the CME Group, quietly issued an emergency advisory. Notice number 26-019. To the untrained eye, it looks like a boring PDF. To anyone who understands how this market really works, it was a declaration of war. Effective immediately, the CME altered how margin requirements for precious metals are calculated. Instead of a fixed dollar amount, they shifted to a percentage of notional value. For silver, that percentage was set at 9%. Let me translate what that actually means. With silver trading near $85 an ounce, this rule change instantly increased the cost of holding a single silver futures contract by roughly 15%. Margin jumped from roughly $32,500 per contract to over $38,250. Nearly $6,000 in new cash, demanded immediately. No vote, no warning, no debate. Why now? Because yesterday morning, silver went vertical. It gapped from $82 to $85. It surged to $86 in early electronic trading. And in that moment, the commercial banks, short millions of ounces of paper silver, were staring straight into insolvency. They needed the buying to stop. They needed leverage flushed out of the system. And the fastest way to do that is to raise margins. This is how the exchange applies pressure. Every leveraged trader is suddenly forced into a decision. Wire thousands of dollars in fresh cash right now, or we liquidate your position for you. It is a forced liquidity drain by design. It is engineered selling. We've seen this weapon before. It was used to smash silver in 2011. It was used again in 2020. And for a brief moment this morning, it looked like it might work again. Look at the 30-minute chart. Look at the red candles on the far right. At the exact moment the margin news hit trading terminals, silver collapsed from $86 to a low of $83.57. That was not natural selling. That was algorithms reacting to a rule change. That was leveraged speculators being liquidated because they couldn't afford the new ante. That was the exchange pulling the lever. And now comes the psychological operation. The mainstream media will tell you that this drop proves the rally is over. They will tell you the fever has broken. They want you to see that red candle and feel fear. They want you to believe the bull market just died. But before you panic, you need to look closer. Because what happened next is the most important signal of this entire cycle. In 2011, when the exchange raised margins repeatedly in a single week, silver collapsed. It didn't hesitate. It didn't resist. It was crushed. The price fell nearly 30% in days, plunging from $50 to the mid-30s. It was a massacre, and it worked exactly as intended. In 2020, during the pandemic panic, margin calls poured gasoline on the fire. Forced liquidations drove silver all the way down to $12. Again, leverage folded. Again, paper broke. History told us that when the exchange raises the cost of poker, the players fold. But today, Tuesday, January 13th, 2026, they didn't fold. They called. After the margin hike hit, silver dropped sharply, slicing down to $83.57. And then something happened that should not happen in a paper-driven market. It stopped. Look at the very last candle on the chart. Look at the long lower wick. The price was hit hard, shoved downward by force, and immediately bought. Not minutes later, instantly. as if there was a bid waiting underneath the market. As I speak to you now, silver is trading near 83.90. It absorbed a 15% margin hike, one of the most aggressive punitive increases the CME has deployed in years, and all it produced was a $2 dip. That is not weakness. That is strength. That is the strongest bullish signal we have seen in this entire cycle. Think about what just happened. The exchange actively made it more expensive to buy silver. They used their largest weapon. They tried to break momentum, crush sentiment, and force capitulation. And all they achieved was a temporary pullback that was immediately bought. Why didn't it crash? Why didn't we see the waterfall selling that defined prior cycles? Because the buyers at $83 are not using margin. They are not speculators staring at RSI indicators. They are not chasing momentum. They are cash buyers, industrial buyers, sovereign buyers, entities that do not care what the CME margin requirement is because they are not gambling on paper. If Samsung needs silver for batteries, they do not post margin. They pay cash and take delivery. If an industrial fabricator sees the price dip to 83, they don't panic. They accelerate purchases. To them, it's a sale. You cannot margin call a cash buyer. And this is the structural change that the banks did not account for. The margin hike only hurts paper longs. It does nothing to stop physical demand. In fact, it helps physical buyers by flushing weak hands and offering cheaper metal. The very weapon designed to suppress the market ends up feeding it. This confirms our core thesis. The silver market is split in two. The paper market is being battered with rule changes, margin hikes, and forced selling. The physical market is being driven by scarcity and necessity. One is a casino. The other is survival. The banks are trying to put out a forest fire with a water pistol. They can knock the flames down for a few minutes, but the heat is too intense. The fuel is too dry. And while this financial battle was unfolding on the charts, something far more alarming was happening at the political level, because margin hikes are a financial response. What we saw next was a geopolitical one. While the exchange was busy changing the rules of the casino, the United States government was doing something far more revealing. They were asking for help. Early this morning, we received confirmation that Treasury Secretary Scott Bessent convened an urgent, unscheduled meeting with the finance ministers of the G7 nations. No advance notice. No routine scheduling. An emergency call. The official topic was, quote, securing and diversifying supply chains for critical minerals. To the uninitiated, that sounds like standard bureaucratic language. Harmless. Procedural. The kind of thing governments say all the time. But context is everything. They did not call this meeting last month. They did not call it last year. They called it today, Tuesday, January 13th, one day after silver spiked to $86, one day after the Shanghai premium blew out, one day after the market signaled that physical supply was no longer keeping up with demand. When a Treasury Secretary calls an emergency meeting about supply chains in the middle of a commodity price shock, it is code. It means the flow has stopped. When governments say they need to secure supply, it means they are no longer confident it exists. And when they say they need to diversify, it means they are too dependent on parties they do not control. Now look at the map. China is the third largest silver producer in the world and the largest refiner. Russia is a major producer. The broader BRICS bloc controls a massive share of global output and processing capacity. The West, by contrast, dismantled its strategic silver stockpiles decades ago. The United States has zero strategic reserves. None. We rely entirely on the global just-in-time market. And just-in-time is dead. We are now in the era of just-in-case, and the United States government has just realized it has no case. This meeting connects directly to what happened on January 3rd in Venezuela. The media told you that operation was about democracy. We told you it was about resources. Stage 4 empire behavior. Desperate acquisition as domestic supply fails. Now, just 10 days later, the same panic has reached the metals market. The empire is confronting a brutal reality. You cannot fight a kinetic war, build a green energy grid, and run a digital economy without massive amounts of silver. Modern warfare is electronic. Every missile, every fighter jet, every drone, every satellite relies on silver. It is the best electrical conductor known to man. You cannot build guidance systems without it. If the silver supply chain snaps, and dealer delays suggest it already has, the military-industrial complex does not slow down. It stops. That is why the Treasury is involved. This is not about coins or collectibles. This is about national security. The response we are watching is coordinated. The CME hikes margins to smash the paper price and buy time. The Treasury convenes the G7 to coordinate access to physical supply off-market. They are trying to form a buyer cartel. They want Europe, Japan, and Canada aligned so they can lock up future production from friendly jurisdictions before China takes it. But there is a problem. China is already there. They signed the offtake agreements years ago, while the West was distracted by ESG metrics and paper derivatives. The G7 meeting is not a display of strength. It is an admission of weakness. If they had the metal, they wouldn't need to meet. If the market was functioning, they wouldn't need to secure it. The price spike didn't cause the panic. The panic revealed the shortage. And notice the language shift. For decades, they told you silver was just a shiny rock, a barbarous relic. Suddenly, it is a critical mineral. The reclassification is deliberate, because once something is critical, intervention becomes justified. This is how the gate begins to close. The phrase critical minerals is not a coincidence. It is a signal. When a government reclassifies an asset, it is not redefining reality. It is preparing authority. By labeling silver as critical, the state creates the legal framework to intervene. It opens the door to the Defense Production Act. It allows industrial allocation to override market allocation. It gives them the power to decide who gets metal and who doesn't. And that is where this is heading. Because when Samsung needs silver for batteries and Raytheon needs silver for missiles, and you want silver to protect your savings, the government is not going to treat those demands equally. One of them will be labeled essential. The others will be labeled optional. You already know which side you're on. The emergency G7 meeting wasn't about calming markets. It was about control. It was about coordinating how to secure physical metal without bidding the price even higher in public markets. They are trying to lock up supply quietly, behind closed doors, before the shortage becomes undeniable. But here's the part they cannot fix. You cannot create silver by decree. You cannot print a mine. It takes a decade to bring a new deposit online. Environmental permitting alone takes years. Labor shortages, energy costs, and geopolitical risk make it worse. Even if every G7 nation agreed today to fast-track silver production, it would do nothing for this cycle. The shortage is here now. This is why the language is shifting from price stability to supply security. It is the same playbook used in energy crises and wartime logistics. First, they acknowledge the asset is critical. Then they prioritize usage. Then they restrict access. This is how markets transition from free to managed. We are already seeing the early signals. Governments talk about hoarders. Media narratives shift toward fair distribution. Retail ownership starts being framed as selfish rather than prudent. The moral groundwork is laid before policy follows. I understand this. None of this would be happening if silver at $86 was a speculative bubble. Governments do not convene emergency meetings over bubbles. They convene them over shortages. The CME margin hike was the financial response, a blunt instrument meant to smash sentiment and buy time. The G7 meeting was the political response, an admission that time is being lost. And this is where the narrative breaks for the establishment. Because while they were raising margins and issuing communiques, something else was happening in real time. Something they cannot control with policy. Metal was leaving the system. Every attempt to suppress the price made physical silver cheaper for the very buyers they feared the most. Industrial buyers. Sovereign buyers. Entities that do not sell back into weakness. The margin hike did not stop demand. It redirected it. The G7 meeting did not create supply. It confirmed its absence. And now the consequences are becoming visible. Because the market has found its defense. Not in New York. Not in London. 7,000 miles away. The reason the margin hike failed is simple. It sits 7,000 miles away. While the CME was trying to smash the price in New York, the Shanghai Gold Exchange closed with silver fixed above $93 an ounce. That created a nearly $10 gap between the Western paper price and the Eastern physical price. This gap is the shield. In previous cycles, it didn't exist. In 2011, the global market moved as one. When New York sold, everyone sold. Today, the market is split. The West trades contracts. The East trades metal. And that changes everything. If the CME succeeds in smashing silver to $70 while Shanghai pays $93, the arbitrage becomes unstoppable. Traders would buy every ounce they could in the West and ship it east for a risk-free profit. The COMEX vaults would be drained in days. This is the trap the banks are in. Smash the price and lose the metal. Let the price rise and lose solvency. The vault data proves which battle they're losing. Over 2 million ounces of silver left the COMEX system in a single day. Registered inventory, metal available for immediate delivery, fell again. The margin hike didn't stop the bleed. It accelerated it by putting silver on sale for the strongest buyers on earth. That is why the G7 is panicking. You don't convene emergency meetings when supply is abundant. You do it when metal is disappearing. The talk of securing supply chains is an admission that the flow has broken. And now the system is reaching for its final lever. Retail restriction. Costco has imposed hard limits on silver purchases. The U.S. Mint has delayed new orders. In the futures market, traders are fighting to stay in the delivery month, refusing to roll forward because they don't trust future supply. This is what a squeeze looks like. The CME raised margins and failed to break the market. The Treasury called the G7 and revealed vulnerability. The Shanghai shield held. The price is still near $84. That price is not weakness. It is proof. It proves the shortage is real. It proves the banks are losing control. And it proves that the metal everyone is scrambling to secure is the same metal sitting quietly in strong hands. The empire struck back, and it missed.